Good morning, everybody, and welcome to our final IFRS and corporate reporting webinar for 2024. It's scary when I say that out loud, Kevin, but this is the last one for the year. And we are ending the year with a new IFRS. So we haven't had a new IFRS for a few years. We had the big bang of IFRS 9 and 15 and 16, and then there was IFRS 17 around insurance contracts, but it didn't impact that many of our clients. This one is a big one. It's going to impact each and every entity because it's around presentation and disclosure in financial statements. So we're looking at the new IFRS 18. As always, I'm joined by Kevin Frohbus, an advisory partner based in our Sydney office. So good day, Kevin. Good to see you.
Hello, Aletta. It's good to see you again. I actually saw Aletta last week at our national conference in Gold Coast, so it was good to see her then. And Aletta, hope you're back in Melbourne and doing well.
Yeah, no, it was fantastic to see you and the whole team last week in the Gold Coast, Kevin. We had 3 days, imagine this, 3 days talking about our beloved IFRS accounting standards, all the latest developments. It was really a fantastic time. We also had our colleagues from New Zealand there, so it was really lovely. We would like to begin by acknowledging the traditional owners of the land on which we meet today, and we pay our respect to elders past and present. In Melbourne, I'm on the land of the Wurundjeri people of the Kulin Nation, and we extend that respect to Aboriginal and Torres Strait Islander peoples here today as well. I just wanted to flag that BDO Australia has published our third voluntary sustainability report. It was published on the 31st of October, and it's talking about our voluntary disclosures. We use the World Economic Forum IBC framework as a guiding principle, talking about principles of governance, our people, planet, and prosperity. A beautiful document, well down to Cara, our COO, and Melissa Simmons from our clients and markets team, who's coordinated the whole firm to get a lovely publication together. So if you wanted to look at it, you can read that. The other thing we have done is we have scheduled our webinars, our IFRS and corporate reporting webinars for next year. And we'll kick off the year on the 22nd of January, so just before Australia Day. If you're still on annual leave, you can always watch a recording. If you register, you'll get a recording afterwards. And we look at what's hot and what's not in 2025. And then we have a number of very interesting sessions planned. You can see in March, we look at power purchase agreements and how do you account for that. We're looking at accounting for climate and other uncertainties, not in the sustainability report, but in the financial statements. We're looking at accounting for technology and software costs. As always, impairment testing. In October, we're looking at Australian carbon credit units and accounting for them. So it's a real focus on the IFRS accounting standard aspects, but there is a bit of a climate and a sustainability flavor to them as well. So there's a link where you can register for the webinars for 2025. We've also scheduled our webinars, our sustainability webinars for 2025. Next week is our last one where we look at climate-related disclosures in Australia, the Maroon one. And then you'll see in January, just after Australia Day, we're starting with the year of mandatory sustainability reporting. Get ready. And then the whole year, basically, we are unpacking AASB S2. We will have a whole session in March just looking at the first pillar, and that's governance. Then we'll have 2 months looking at the strategy pillar. Then we look at the third pillar around risk management. The fourth pillar around setting targets, measuring carbon footprint, and at the end of the year we wrap it all up and we bring it all together. Our whole focus next year is getting organizations assurance ready around AASB S2. So this is a big focus, and we invite you to register for those as well. So today's agenda, as I said, we're looking at the brand new IFRS 18. It will impact each and every entity. The good thing is that the transition and effective date is a few years away, but it's important to get ready because we might need some system changes and new thinking. So Kevin will step us through this agenda. These are the sections. Kevin and I and our whole team, Australia and New Zealand, there were 25 of us in the Gold Coast, unpacked IFRS 18 together, and Kevin will share a lot of those insights today. We'll follow it up with regular newsletters. We'll follow it up in webinars in future as well. So Kevin, ready for the last IFRS corporate reporting webinar for 2024?
Thanks, Aletta. And yes, it is a big topic. In fact, I'm not sure how we put this one in December. We're really challenging you today because it's not an update, it's a brand new topic. So there's a lot going on here. As Aletta mentioned, it is a few years away. So in terms of the way you're listening to this webinar today, it's probably just to sort of understand the concepts and where they're going with it, and at least start to think about the practical effects, which you'll see towards the end, because we have started to see that this is more than just rearranging your profit and loss in a particular way at the end of the year. You might even need to have some system changes, and especially tagging of different accounts into different in your chart of accounts. You might even need to create in your general ledgers and trial balances different accounts to keep track of particular items, because they go to different places in the statement of profit and loss going forward. So if the only thing you take out of today is awareness, so you can start to think about what this means for you, then that is probably will have achieved our objective. Aletta has mentioned there's a couple of guidances coming out, and BDO has already put out an IFRS in practice, which I've got a slide on later on. But there's a second part to that coming as well. So keep your eye out for it, because there will be a number of publications coming out as time goes on. So let's get into the background and summary of IFRS 18. As Aletta mentioned, this is a brand new standard. It's the presentation and disclosure of financial statements. Now, most of this is focused on the statement of profit or loss. However, not all of it. But so when I say profit and loss to you today, I'm really talking about the section that starts with revenue down to sort of profit, and also the minority interest component of that. Not really talking about statement of equity or other comprehensive income or the balance sheet, although there are some amendments that affect the balance sheet and some of those statements. So just kind of keep your eye out. But it's very much a presentation standard. And what they've really done is we've moved the IAS 1 presentation of financial statements that will essentially be rolled into this new IFRS 18. And that's kind of fundamental if you think about it, because IAS 1 was like the very first standard under the old IAS before it became IFRS. And now we're getting rid of that with a brand new standard. So you can see how we're progressing. It is a big change. A couple of things that will move across. Most of the things in the middle column are essentially just moving across to the new standards, things like comparatives and frequency of reporting, annual reporting and stuff like that, offsetting, classification of assets and liabilities moving across, although just bearing in mind classification of liabilities as current and non-current has just gone through its own big change quite recently, and that's currently effective in this year. Going concern, some of those things are all moving across, essentially unchanged. The big issue, which is really today's agenda, is how the structure of all of the presentation items and how the categorization works in the profit and loss. And there's also some flow-on amendments to categorization in the balance sheet, for example. We'll then talk about mandatory and additional subtotals. This is really important because one of the big drivers of this, or at least one of the big consequential amendments of this, is trying to reconcile totals to the way management talks about performance in public announcements. Now, we all know what we're talking about here. When you have normalized earnings and EBITDA and all these, I want to call them exotic performance measures that are used in investor presentations and so forth, there's always been this vexed issue of how does that reconcile to the IFRS statement of profit or loss. So part of what this is about is to solve some of that. I don't think it solves it, but it does start to bridge the gap substantially in those issues, and you'll see later on how it actually brings these management performance measures, which is item 3 on the list, actually into the financials. So what's really happened, I know in Australia, for example, we often have non-IFRS disclosures and sort of performance measures outside of the financial statements, but it's in the director's report, and ASIC has guidance on how you reconcile those numbers. This is now sort of doing the same thing, but it's bringing that reconciliation into the body of the financials, which means it'll be subject to director's declaration and it'll be subject to audit by the auditor, as part of the actual financial statement. So it actually has some real flow-on effects. And then we'll talk about aggregation and disaggregation and transition and effective date. So you can see where this is heading. It's not just moving things around. It's actually also, how do we talk about those numbers? What numbers are mandatory? How do they reconcile to communications out to your investors? And very importantly, that reconciliation between how you talk about performance and how you report it in the statement of profit and loss is going to be in the body of the financials, subject to specific rules, subject to audit, subject to director's declaration. So there is a big shift coming here. So we'll look at that today. In terms of a snapshot of what's going on, and this is just a different way of presenting some of what I've spoken about already. The snapshot of it really on the primary financial statements is to essentially provide a structured, useful summary of assets, liabilities, income, and expenses. 2 new defined subtotals will be appearing. Now, this is one of the big takeaways today. You will have to report 2 subtotals and actually label them as such: operating profit and profit before financing and income taxes. We haven't really had that before. We've had it in different forms and different variations, but very clearly articulated now is you're heading towards 2 mandatory subtotals: operating profit and profit before financing and income tax. And I'll show you now soon how we get there. And then they are categorizing the classification of income and expenses. Now, this will look similar to the cash flow statement. This concept of investing, financing, and operating activities. There's essentially 5 categories: operating, investing, financing, income taxes, and discontinued operations. None of those are new concepts, but the concepts in the presentation of profit and loss is, and something else to point out is, it's not the same. When I talk about operating, investing, and financing, it's not the same in profit and loss under this standard as in the cash flow statement. There are similarities, but they're actually not the same concepts. They're somewhat different. So don't think about operating, investing, and financing as a cash flow statement concept rolling into the profit and loss statement. It's not that at all. It's almost a brand new concept and almost a brand new categorization, but it has had consequential amendments back to the cash flow statement because they're also trying to bridge that gap a little bit as well. So you'll see that coming through. In terms of the notes, you will see there that one of the big changes in terms of the notes is this concept of management defined performance measures. There it is in the notes, which is reconciling the subtotals or numbers in the statement of profit and loss with these performance measures that management use to talk to investors in their communications with investors. So that concept of, if you're using a measure like EBITDA, you actually need to do a reconciliation and bring that into the body of the financials. And there are specific rules now about how that would be disclosed. Bear in mind, this is a few years away, so don't panic yet. So there's a little bit a way to go, and I imagine along the way, ASIC will tidy up its guidance on how this reconciles, because obviously ASIC has got some local Australian guidance out on this, but these changes are international. So now you've got an international standard dealing with things like management defined performance measures. So the regulator in Australia will probably, change and amend their guidance along the way. But I think they're trying to do the same thing, which is essentially reconcile what's in your statement of profit and loss with how you talk to your investors. That has always been a vexed issue in accounting, and this is one of those things, or one of those standards that will try and address that to some degree. So I think then, Aletta, if we jump into the next slide, then just give me if you jump to the next slide, then these are the sort of the 3 categories or the 4 categories that we're dealing with today. as well as the primary changes. Categories in the statement of profit and loss, new subtotals. We'll be talking about aggregation and labeling, and then disclosure of information about management-defined performance measures. Now, I did mention before that we've got a publication out on this, so this is the next slide. I put this in last night. I've called this comprehensive part 1 publication. Why part 1? Because Video Global and hence Video Australia have put out an IFRS in practice on this topic. It's a 108-page guidance, but it's part 1 because there's going to be a separate IFRS in practice coming out that actually deals with the management-defined performance measures, because it's such a big topic and it's going to have such ramifications. Because, as I said, financial statements are one thing, but communicating with investors is another. And those management-defined performance measures are essentially bringing those investor type communications into the financials. So we'll have a separate publication for that in early in the new year. Aletta wants to say something.
Yeah, Kevin, I wanted to say that it's interesting that the IASB has really prepared the standard with an investor focus. You know, previously when they came out with the revenue recognition standard, the leases standard was really driven by investors and their information needs. And this is another example of this really strong research, collaboration, outreach with investors. So what we put in the financials and what goes in investor presentations are linked, and that's where those management defined performance measures are so important.
It's interesting as well, Aletta, because this concept of primary financial statements is the concept of reporting for investors, and it's always really been there. But that is right. The standard setters have moved very sharply towards investor needs, and that's the same as sustainability reporting. So the whole concept of the mandatory climate statements that are coming in under mandatory reporting is an investor focus. So that is coming across quite strongly. And it is also true, it's not that they do these standard settings in isolation. You know, IFRS 18, IFRS 15, 16, sustainability reporting, they're actually all part of a much broader progression towards investor information and investor communication, and that's really important. And it's interesting because, as you some of you might know, my partner is in investor relations, and I already got questions at home over the dinner table on this standard almost before we got across it, because investor relations management, they'd heard this concept of management defined performance measures coming, and obviously it's a tool on how the investor community is communicated and how the investment managers or investor relations people have to actually understand and manage that communication. So yeah, big shift from just providing information to actually communicating with investors. That's really the key that's coming out of this.
And I think even that consistency between what's in the financials and what we then present to investors, or say, listen, if both are aimed at investors, it should be the same or reconciled similar. Yeah, it should be the same.
Thank you for talking about the elephant in the room. That's exactly the international standard setters argument, is why isn't operating the profit the same for everybody? And that is partly what this is trying to achieve. And interestingly, that is a good segue then into the first section of the presentation, because the first segue talks about categories in the statement of profit and loss. And just for reference, when I talk about profit and loss going forward from this point for the rest of the webinar, I mean the statement of profit and loss and other comprehensive income. I'm talking about the profit and loss section. It's going to use that as a short circuit. But this one here is essentially the first big change. These concepts of categorizing items of income and expenses into 1 or 5 categories. And it's essentially, shall we call it a bottom-up approach, if you will. The way the standard is written in terms of presentation is to first identify whether you have items of income and expenses that are categorized as investing, then financing, identify then your items of income tax and the items associated with discontinued operations. And then everything else is residually an operating item, which in theory then leads to, then surely you can have an operating profit number that should be reported to investors. That's the theory. This, of course, is not going to make some of our investor relations friends happy and CEOs and the boards, because they still want to dabble with operating profit a little bit and start taking things out because they want to normalize things, which is where you get the management defined performance measures. But the reality of it is if you're able to pull out your investing and financing and discontinued operation and tax items, everything else should be a result of your operations and therefore an operating item. That is the thinking. So the standard will require you to do this, and you can also then see how your trial balance, chart of accounts, all those things will follow, because you'd want to tag your transactions into common accounts in accordance with these categories. So when you get to a presentation at the end of the year, you can just present those items neatly and aggregate them neatly into your financial statements. So let's quickly go through what these are. So investing is income and expenses from, and this is the definitions: income and expenses from investments and associates, joint ventures and unconsolidated subsidiaries, cash and cash equivalents, and other assets that generate a return individually and largely independently of the entity's other resources. For example, rental income from an investment property. So the rental income is quite independent from all the other assets. Essentially, its own little cash generating unit. That is the definition of an investing entity. So you need to get your cash and cash equivalent definition right first, and we've had issues with that. In fact, last month we spoke about misclassifying items of cash and cash equivalents, and also investments in associates, joint ventures, and unconsolidated subsidiaries. Quite clear. Everything else will not be investing, is what this categorization basically says. You head down to financing. Then financing is income and expenses from liabilities that arise from transactions involving the raising of finance, so capital or debt. And then certain interest and expense items arising from the changes of interest rates in accordance with other accounting standards. And we're talking about things like interest arising on lease liabilities and interest arising on provisions and interest arising from, let's say, significant financing in revenue transactions. Essentially, some of these other accounting standards that create out of them interest expense line items. This is really important because, once again, if you don't fall into that definition, it's not financing. And then you can see very quickly how you can end up with everything else is in the residual category of operating. And one of the best examples, which I'll put on the table right now, is share-based payments. So we've had this situation before where no one really knows where to classify the expenses from share-based payment arrangements. Now, I think it's obvious. It's a remuneration category. If it's if a share-based payment expense is with an employee, it should be in remuneration. But because it doesn't quite feel like traditional remuneration and it doesn't feel like a bonus, it's sort of non-cash and it relates to equity, you sometimes find this item floating around on the face of the profit and loss, or sometimes it's sort of sitting somewhere else. What this categorization does is puts it very clearly into operating. It says, well, hang on, it's not from investing. It's also not from financing, because when you account for share-based payments under the IFRS 2 standard, nowhere out of the accounting of the share-based payment does interest expense drop out. What does drop out is a fair value measurement for the award. And there's fair value measurements that go with it, but those fair value measurements are not interest expense. So therefore the movements and the adjustments that relate to that will drop into operating, because it doesn't fall into the other four categories. And so therefore, very clearly, share-based payment expenses with employees is an operating item and categorized as such. So I think that's a good segue. I think at this point, if you're not reeling, we will take you on a journey of what the statement of profit and loss looks like. Yuri is a good example of what our new and revised statement of profit and loss will look like. You can see us starting with revenue down to cost of sales and gross profits, which is not mandatory. You don't have to report gross profit and cost of sales. It depends how you classify nature and function. But this example has revenue, cost of sales, and gross profit, down to other operating income, selling expenses, research, and general admin. That's not unlike what we're used to. But what is important here is that the items that are aggregated and disaggregated into those line items are classified as operating. So everything else that didn't fall into investing, financing, income, and discontinued operation is above the operating profit line, is essentially what this is all about. And that's the trick, because what tends to happen currently is you'll get an operating profit line or some sort of measure of profit at the operating profit line. And then you start to see things like share-based payments or impairment or amortization start to kind of come in, almost like a quasi-exceptional item, or unadjusted and unnormalized items. This categorization pushes everything clearly back up into above operating profit, and you need to stick it into one of those line items. The two other items I'll kind of point out on this slide is the two mandatory subtotals, operating profit and profit before financing and income tax. So you can see those sit in there. Those are now, or will be, mandatory subtotals. And between the two of those is then the investing line item. So for example, if you remember the definition from investing, it was investments in associate, income and expenses from cash and cash equivalents, and other assets that generate returns by themselves or largely independent of other resources. So those are the things that would then be in the investing category, which then drops us down into the profit before financing and income tax, another mandatory subtotal. We then move to the financing line items. So remember, that's items that relate to transactions involving debt or the raising of finance, and some of those interest and expense items that arise from other standards like interest expense in revenue or provisions. There is an additional subtotal that's put into this example. It's not necessarily required, profit before income and income taxes, but I guess it is well accepted in the industry that that line item exists, so this example has it in. We then have an income tax line required, profit from continuing operations, the discontinued operations, and then the mandatory profit at the end, which is the end place before you get to minority interests and other disclosure issues. So that is the big change, I guess, from this standard. It is worth pointing out that some types of entities, which I actually deal with on the next slide, would report some items up in operating, where, and this is generally an exception to the financing investing categorizations. So, for example, and I'll start on the right hand side here. If we take a bank, for example, that provides financing to customers, if you apply the definitions the way we've read them out, your income and expenses from changes in interest rates with banking customers is going to end up under financing. That's not appropriate for a bank. That's part of their main operating activities. So there are exceptions to the classification rules depending on the type of sector or business you are, or the types of assets you have, where you could end up with some of those financing and investing items ending up in operating because it's essentially your main business. This is a much bigger topic than today, but I think it's because obviously there's a lot of judgment and a lot of guidance around this, hence our publication, which will take you through that. There's a lot of information on this, but essentially we're talking about investing in particular types of assets like real estate portfolios and providing financing to customers will move some of those items from financing and investing up into operating, because that's your main type of business and or business activity, and therefore you will have exemptions to some of those definitions. I think then we'll move through some of this a bit quicker. This is just a slide to kind of show you where the different definitions change if you have a main business activity exemption. So for example, if we're talking about items that need to be classified as investing, remember the definition of investing activities was profits from associates and joint ventures accounted for using the equity method, income and expenses from cash and cash equivalents, and income and expenses from items that generate returns individually and largely independent. When you are either operating a type of asset or a business that provides financing to customers, it's the bottom two items that may not end up in investing. Those bottom two items would then end up in your operating section. But what's important here, this is really important for a number of clients we have, is that the share of profits in associates and joint ventures using the equity method, there is no exception to that being classified as an investing item. So it will always be investing, and it will always be shown below the operating profit line in the new statement of profit and loss, those profits of associates and joint ventures under the equity method. That provides a lot of certainty to a lot of organizations, because I've noticed that equity accounted associates and joint ventures tend to currently float all over the statement of profit and loss, depending on how important it is to the business. Is it up here part of my operations, or is it down here somewhere below my interest? This gives very clear clarity that those items are investing, and they will be below the operating profit line going forward, but above the profit before financing and income tax line. Right. And there I've shown it to you. Just a quick visual. Moving on to the financing category. This is a little bit more complicated. There's a lot of detail on this slide, but I've actually covered this already. So I'll just kind of high level it again. What is the financing capital? The financing capital really is two types of liabilities give rise to financing categories. And it's probably worth at this point just pointing out that the investing category, which we've just dealt with in the previous slides, is very much an asset-driven category, whereas the financing category is very much a liability-driven category. So you shouldn't be ending up with things in your financing category that arise from a liability. Something is not right then. This is sort of really clear. So let's talk about the financing category. It's liabilities arising from the raising of finance. So we're talking about debt instruments and certain supplier finance arrangements. And what it covers then is really income and expenses that arise from the initial, subsequent, and derecognition of those items. So that's really important. The liabilities arising from the raising of finance, it's everything from start to finish that relates to those types of financing transactions. And this is also something that we've struggled with as a profession up until this point, because what we sometimes find is you'll find interest easily ends up in the financing category or interest expense, but sometimes there's remeasurements for a modification of a liability, and nobody really knows where to take those. Because you've kind of got this fair value adjustment halfway through a liability. So this very clearly articulates that all the items that relate to those liabilities from start to finish end up in financing category, which means they will then end up in essentially your income, your interest expense line item, or just above profit before income taxes. On the other side of the diagram, you see other liabilities. And it took me a while to understand this language. This is one of those moments when I was kind of getting to grips with the theory. It's not written easily, as all accounting standards are. They're there to confuse. But what it's trying to get to is some other liabilities, like payables for goods and services, sometimes have interest attached to them. So because they've got deferrals beyond a reasonable period. So if we take payables for goods and services, they generally don't have interest recognized separately because they're generally short term and they're paid really quickly. But you can have situations where your goods and services are paid for over an extended period of time, and now you start to recognize interest on it. And that's the same with lease liabilities, revenue contracts, and certain provisions where we have interest. If you have an other liability that under the accounting standard that it's recorded under creates, let's say, an interest expense line item, that interest expense will end up in this category too, but not all the other entries that arise on its initial recognition or subsequent measurement, in terms like, let's say, a modification or derecognition. Those items will very clearly end up in operating. So yeah, you have the situation where everything related to debt from beginning to end on the left-hand side will end up in the finance category, but only the interest expense elements, let's say, or the interest income items under the other liabilities will all their other measurement and remeasurement items that arise under accounting will end up under operating. So you can see what's happening here is you need to really be clear about what the transactions are, what they're linked to, and how do you code those transactions to the right category in your trial balance. Because if you put everything to an interest expense line related to payables for goods, for example, you're going to have to go later on and pull out the transactions that are not finance transactions and then into operating. And this is where this starts to get a bit tricky. Any comment, Aletta, on that one? No, I think you're happy with that?
Yeah, no, I think, Kevin, when we discussed it last week in the Gold Coast, the bit that really explained it to me really nicely is if you've got provisions for restoration, where currently the note is a little bit vague. You've got an opening balance, you've got an increase, you might have a use of the provision. We don't specifically articulate the unwinding of the interest in the note currently. And going forward, you'll have to capture it separately and put it in this part, right? So it is a bit of extra complication, and I think one will have to map it differently in your GL and your trial balance. So that example helped for me to understand how complicated it could potentially be.
Yeah. All right. This standard just kind of just articulates again that there are some exceptions to the classification. I've already spoken about the main business activity exceptions, but there are some other exceptions from the financing category related to derivatives, some type of investment contracts under the financial instrument standard, IFRS 9, and also the insurance contract standards. Not going to get into that today. Some of that stuff's complicated and difficult to work through. Not everybody will have those exemptions, but just pointing out that the financing category does have some further exceptions about moving those to the operating section, because that's what they're trying to do. Everything that is exempted from the investing or financing category that doesn't fall into the discontinued operation or the income tax category ultimately residuals to operating. And that's what these exemptions are about. They're trying to essentially push these things to the operating section. All right. Moving along at a rapid and stilted pace in the interest of time, just pointing out where the interest expense line will go for the financing activities. Kind of covered that in our main. I'm going to whip through these pretty quickly. It's not that these are new or different. It's just to kind of point out that the income tax and discontinued operations categories are also well defined now. So essentially, it's all the income and expenses related to the discontinued operation goes into the discontinued op, and the same with the income tax category. Everything that's related to tax expense or income tax goes into income tax if it comes out of the AASB 112 or IS 12 income tax standard. What's interesting here, which you'll pick up later on again, is the foreign exchange differences tracks the related income tax expense as well. So just bear that in mind, because I think what often happens now in practice is the foreign exchange differences just gets all lumped to a foreign exchange account. Sometimes you have unrealized gains and sometimes you have unrealized losses on foreign currency transactions, but it's not split out any further. Yeah, you have to start to split out the foreign exchange differences tracked to the income tax items separately and report them in this category. And that's also true for some other foreign currency transactions. So the foreign exchange differences related to interest expense that is in the financing category will track that transaction in the financing category and will be reported along with it in the financing category, because it's all income and expenses related to the debt in financing or the tax in the tax category. And that was when this thing dropped for me about tracking items, because you will have to start to understand your foreign exchange differences, link them to the related either income and expense item or to the asset balance they relate to, and follow them into the category that they belong, whether it be income tax, discontinued op, investing, financing, and then residually operating. So that'll be my takeaway there. And then finally, our operating category is essentially our residual or default category. Almost everything wipes up into it or down into it, depending on the way you look at it. And that includes if your main business activity drives certain things there as well, which we've already discussed. All right, Aletta, I think we'll move on. I think we actually covered this there. I'm just pointing out where all the operating items are. Why I put this slide on in this point is that once you're in the operating category, you still have to aggregate and categorize by nature, function, and example. So you can see here we've got general and admin expenses, selling expenses, cost of sales. So that doesn't go away. It's just that what goes into those categories now is driven first and foremost by whether the items are by nature operating, and then you categorize them into financing or nature or function. How do you assess what's main business activities? This is related essentially to whether your main business activity is something other than like a bank or so forth. You'll have to go through some sort of process to determine this. And what's important with this is that I think it'll be obvious to most businesses that everything is operating. I think it'll be obvious from the definitions what's investing and financing. But if you've got those single assets or investments in particular portfolios or real estate assets, or you're in the financial services or fintech industry, it'll take a bit more effort to work out whether your main business activity residuals up into the operating section. And I would say that that's probably something to think about in the short term. So I had put a few decision trees on here. I'm not actually, in the interest of time, I won't go through them. I'll just talk through what they're trying to achieve, and you can take that as holiday homework, shall we say. So this first one is just trying to demonstrate the concept that the main business activity assessment is done at the reporting entity level. So where can that get complicated? If you've got two subsidiaries and a parent that do different things, what is the main business activity of the parent consolidated financials? Will it be driven by a reporting entity level at the consolidated level? And you can see how tricky that can become, because the bank at subsidiary A level is probably going to have a main business activity that categorizes its transactions all into operating. But when you get to the consolidation level, you might have a situation where all the bank transactions end up back in financing and investing because the consolidated group has a different main business activity. So already there's a tricky thing, and you can imagine what that does to group reporting. My auditing days, and Aletta, you would have been the same. We used to do chart of accounts, and you had to classify all the things in, and you'd send the pack off to the parent on the 4th of January, just after year end. What they'd categorize at a local level, let's say for subsidiary A on this diagram, won't necessarily be the way they categorize it for parent P if the main business activity of parent P consolidation is something different. So that's going to be one of the very quick implementation issues from this standard. And then on the next slide, this is just a few decision trees on how you might assess main business activities. You'll very quickly work through this if you're not a bank or you don't have income items, related to particular types of business. But essentially, this is talking about how do you raise finance? Do you have finance related to providing finance to customers, which essentially makes you a bank or a financial services institution? And this kind of works through all the types of categories you have, all the way through to cash and cash equivalents, and down at the bottom, I've got some slides there on financial assets and investing. So I'm actually not going to go through that. It's not a worked example. It's actually just some decision trees. You can go through that in your own time. There are some worked examples in our publication where you could apply these decision trees. So what I think I'll do is I'll say to you, the publication we gave you a link to, you could take these decision trees, go find some examples in there, and you'll be able to trace them through and see how the decision trees apply. So I'll leave it at that for, shall we say, homework. Aletta, the slide I'm on now is other areas of classification. It's a few slides away. There's a couple more decision trees there. And then I'll just kind of wrap up this section with, I've spoken about foreign exchange gains and losses. They follow their related items to a large degree. There are some complex provisions around hybrid contracts with host liabilities and derivatives. the implementation examples in IFRS 18 as well as NVIDIA's publication actually has some detailed examples on how that works. So if you've got hybrid contracts and host liabilities and embedded derivatives and the related income expenses items and the same and the same with sort of some investment contracts, you actually do need to work through the detailed guidance on that to decide where the categorization is, because as you can obviously see, there's a conflict between, are these financing, investing, or operating? That's where this comes, because different types of derivatives and hybrid contracts and financial instruments, their purpose isn't so obviously clear. Is it a treasury transaction? Is it an operating speculative? And those decisions would have to be worked through. So I'll leave it at that. Last thing on our profit and loss is our subtotals. We've already spoken about these on the next slide, which is basically our current requirements. We've got a big question mark there because it's not so clear to anybody what the current requirements are. I would say that profit or loss and profit before income taxes are the current requirements, but I've seen every variation of a subtotal or a total. The new standard will very clearly talk about operating profit or loss before financing and income taxes, and profit or loss at the end. So those sort of three are required. And now you can see why it's really important to get the operating categories right, because everything that's in the residual operating category will then drive your operating profit or loss number, which is a mandatory subtotal now under the new standard. All right. I am kind of whizzing through it a little bit. I put another case study. Yeah, this is a good example of a classification from current to the new standard. Nothing has changed other than we've moved things around a bit, but you'll see that some of the line items have changed completely, and they've changed completely because things like foreign exchange differences have been broken up, and some foreign exchange items are sitting in the operating section, some are in the investing section, some are in the financing section, because they're tracking their related income and expense items. That's not the case currently under the standard. So you can kind of work through that a little bit and follow the 1, 2, 3, 4, 5, 6 itself. Right. The additional subtotal categories is actually more under the management defined performance measures, but whatever you use for additional subtotals in the statement of profit loss, there's now some rules about those. So this is everything beyond those three that I've mentioned are now mandatory. So there's going to be some rules about them. First of all, it must, if you use a subtotal in profit and loss going forward, which is not one of those three, it must comprise amounts recognized and measured in accordance with an IFRS standard. That is going to prevent subtotals that are not IFRS creeping into profit and loss, things like EBITDA or normalized profits, which often creep in sometimes on these statements of profit or loss. It must be compatible with the structure created by the requirements in paragraph 22, which is essentially the structure we've been talking about up until now. It has to be consistent from period to period, so you can't make it up and change it from one period to the other. It's essentially a prior period adjustment if you're doing that, and it must be displayed no more prominently than the mandatory totals and subtotals required by IFRS. So you can't highlight one and not. You can't highlight one of these made up or subtotals, but not highlight the operating profit line, which is obviously a mandatory subtotal. And you can see where they're heading with this is, let's limit this down, let's make this comparable, and let's be consistent, is what they're on about, yeah. In terms of grouping of information and how we aggregate and disaggregate it, there's some new guidance coming on the principles of aggregation and disaggregation. And I think the best way to do this is to actually jump maybe 2 slides later to the double row of arrows. So I've put that one there. So I've put the guidance in, or we've put the guidance in earlier in the slides. But basically, there's a 5-step process now on how do you, once you've got your general ledger and your trial balance and all your items of income and expenses, how do you start to group them, aggregate them, and disaggregate them for presentation? This extends beyond the profit and loss. It also extends to the balance sheet, for example. So this guidance is one of those areas that has tentacles into other areas of the financial statements. First thing is that once you're standing there with your trial balance and all your transactions have been tagged and you've categorized all your income and expenses into operating, investing, and financing, and you've got all your balance sheet items, how do you now group them for presentation? Because at the end of the day, IFRS financial statements is all about an aggregated material presentation of assets, liabilities, income, and expense. So the aggregation is really important. First thing you need to do is identify all the assets, items, all the items in accordance with their various standards. Second step is classify them based on a shared characteristic, such as their nature, function, or a measurement basis, where they have at least one shared characteristic. In the bottom arrow, we've got an example of what we mean by that, which is basically, in this case, you might identify all your financial instrument assets based on their measurement category. So you have amortized costs and you have, let's say, fair value or fair value through other comprehensive income or whatever it might be. Those will then aggregate into a total for presentation, but then there's a step of disaggregation based on dissimilar characteristics, because what you can sometimes do is you can over aggregate and then you start to lose the meaning. So for example, you might have classified everything as amortized cost and as fair value in the second step, but you recognize at some point that the fair value can be disaggregated into instruments that are equity instruments or debt instruments. And even further, equity instruments measured through other comprehensive income and equity instruments measured through profit and loss. So at that point, you disaggregate, because presenting some of those items more disaggregated, and it's often in the notes, is going to be really important. And that then takes us through to the end of the decision tree, which is you present the items and disaggregate things further in the notes. So here we have a situation where instead of just grouping everything into one line out on the balance sheet, being financial instruments, assets, you've actually disaggregated and aggregated them first by measurement category and then disaggregated them by where you take their measurement movements, for example. So that's just the new standard on presentation. Is it a whole lot of new stuff? I don't think so. I think we should have been doing that all along. So that probably just changes it. But one thing it does fix is the use of the other label. Because what tends to happen now, we aggregate and disaggregate all the things we think are important and everything else just goes to other. But we all know the situation where the other category is bigger than everything else on the balance sheet. It's our favorite thing in IFRS. You're running through the balance sheet and you've got trade debtors, you've got inventory, you might even have deferred tax, and then you have this other asset and it's 3 times the size of anything else, but nobody knows what the other is. That's what this is trying to solve, this concept of if you actually aggregate and disaggregate appropriately, you shouldn't have other labels. And in fact, the standard will actually restrict the use of the word other to something more useful and informative. And one of the ways it will do that is you can't just say other, you actually need to describe what the other is. You need to come up with a precise description of other, so other operating expenses. And even then, by applying the disaggregated bucket approach, you might find that you have to disaggregate that further to explain the meaning. So some real new rules about the use of the word other in the standard. Right. Hopefully at this point everybody's still hanging on, because I know how we all love the use of the word other. Let's get into the last big crunch. We've got 5 minutes to go. It won't take that long to get through this section, but you will see why this section probably needs its own publication, as well as it's probably its own webinar at some point. And that's maybe one of our 2026 webinar series will be management defined performance measures. So management defined performance measures, this is essentially, what is this? It's essentially when you use a measure of performance in your public communications outside of your financial statements. And that's essentially bringing this concept of investor communication into the financials and going from there. It's give some examples of what performance measures might look like. So things like adjusted profit, normalized profit, gross profit, adjusted earnings and normalized, those are all management performance measures. The IFRS specified items like gross profits, that's not what we're talking about. So we're not talking about things that are either IFRS specified or some other type of performance measure that's sort of outside of investor communications. We're talking very specifically about these sorts of performance measures that are not IFRS specified, but are used in investor communications outside of the financials. That's what we're talking about. So you can see you have a whole bunch of categorizations going here. Not every measure used in every communication is a management performance measure. It's quite tightly defined. And it's actually more defined because even the forms of communication are defined, which I'll get to in a later slide. What is this on about? It's essentially saying if you have identified a management performance measure, and you'll have to go through a process to identify what they are, and you'll have to look at your investor communications, and you'll have to understand whether it fits into that category. It's essentially at that point needs to be brought into the notes to the financials, where you actually have to show a reconciliation between those measures and the most directly comparable subtotal listed in IFRS in your financials, which is going to be one of those mandatory subtotals, probably things like operating profit. The reconciliation is important, so is the related income tax and non-controlling interest disclosures, but also a description of how that aspect of the financial performance is calculated, and drumroll please, why management believes that is a more useful information measure. And that why I think is going to throw a lot of people under the bus because no one really says why they use different performance measures now. And this is where it gets a bit tricky because the statement about why it is a more useful measure for investor communications will have to be in the notes to the financials, which are subject to the director's declaration and subject to audit. So auditors will have to audit the statement from management about why they believe it provides more useful information about performance. And that is the thing that I think the industry needs to get across, is the concept that these are not throwaway lines. These are going to be audited statements and audited assertions that go in. I've given some guidance on the next slide in terms of how to identify management performance from public communications. Not all communications with investors are management performance measures. For example, social media posts does not count as a management performance measured communication channel. It's mostly just your commentaries, press releases, and investor presentations. We've given you a nice little decision tree on this, which is how you can use to identify this. Now, bearing in mind, this will have to be redone every time you put something new in a communication. You'll have to run this model. But some of these questions are a little bit more vague and a little bit more judgment-based, so you'll have to put processes together. I would imagine that companies, and especially listed companies, would need to develop these in their normal continuous disclosure type processes to understand when they start to talk to investors in communication where they are inadvertently triggering a management defined performance measure. Because you don't want to get to your financials at the end of the year and now you've got to provide a whole bunch of information and reconciliations subject to audit. And then the last two slides are just examples of an example of what a reconciliation in the financials might look like. And what you can see here is the IFRS number and the management defined performance measure on the other side, reconciled by what the items are, splitting out the income tax expenses, and I'd imagine you'd also do your minority and disclosures as well, and providing a description below of what they are and why they're more important measures, or why this measure is more important as a management defined performance measure. So you can see it's quite onerous, and there's a lot to unpack there. That one we will come back to, I'm sure, in either future webinars and publications. Now it's gone 12 o'clock. If you'll just give me 2 or 3 more minutes, I'll whip through the other slides. And Aletta, if you're happy to do a steroid jump to a couple of slides for me, the consequential amendments. I won't deal with that one because a lot of stuff has come forward from previous standards. This one I will deal with. There are some consequential changes to the cash flow statement. I did say earlier that the investing, operating, and financing categories in the cash flow statement aren't the same as the one in profit and loss. That's true. What I can say is that they have tidied up where some of the items like interest expense paid and dividends received and paid will go. Currently, under the cash flow statement, there's a bit of a choice between the operating and investing categories, whereas going forward, there will very clearly be either investing or financing, as you can see in the middle column of that table. There are some consequential amendments to the cash flow statement, to earnings per share, which I will not get into. This is almost niche in a way, but if you've got management performance measures that are disclosed, the earnings per share of those will have to be disclosed as well. And there will be changes then to the interim financials, because as your main set of financials change, so do your interim financial presentation have to change as well. And that is best demonstrated by our transitional slide later on. Practical effects of this, we've already mentioned this already, but I think, look, there's definitely benefits expected from this. Aletta made the comment earlier, they did not do this in isolation to the investor community. This is a global initiative that involved investors, investor groups, and so forth. So this is what the investors are asking for. Maybe the preparers don't share the same view, but the investors certainly are looking for this information. And we often throw that around. Oh, it's more useful information, but they really have gone out of their way this time to take on board the needs of broad groups of investors. Might be at large public companies in Europe have probably been involved, so maybe some of the smaller private companies in Australia don't quite share that view, but it is through consultation we got there. And there will be comparability. You know, this brings us back to no exotic rows and performance measures that nobody understands. But it is true then that the cost of application is that there will be some internal education, which on the next slide later, implementation cost, and there's no doubt in my mind that to keep track of all these things and where their categories grow will be a little bit of a change to accounting systems will have to be endured. So I think that is something we've definitely been given enough time to prepare for this. This is some way away. The first year of reporting on this, which is our transition date, is really the December year ends in 2027. Yes, that's correct. Sorry, I just had to apply my mind to that, which would be your June year ends. Aletta, correct me if I'm wrong. I think it's your June year ends will be June 2028. Will be the first year. But as you can see, there's prior period adjustments required. You're going to restate your comparatives, and also thrown into the mix is your interims will have to change sort of halfway through your first year. Essentially, the interims will change before the annuals will. In this, if you're half year reporting, for example, or quarterly reporting, for example. So there is a lead time there. Now, as much as we say there's a while away, which is true, 2027/2028, you can see from this diagram that if you're a December year end, your first period of restatement is essentially 1 January 2026, which is really only a year away. So the system changes and implementations will have to start to track all this stuff. Similar to leases and similar to sustainability reporting, they are not things you want to do at the end. These are things that you need to roll through your systems and processes almost on a roadmap basis and get across. Some organizations will be easier than others, but some will be severely impacted by this, especially if you've got, you know, business activities that are not quite easily to unpack, multiple foreign exchange transactions that need to track the related nature of investing financing activity. Those things will take some time to get across the line. With that, Aletta, I'll leave it back to you. Thank you very much.
Yes, thank you very much, Kevin. So because it's years beginning on or after 1 January 2027, you know, we've tossed and turned. What do we do in 2025 in our webinars? At this stage, we're going to focus on getting everybody ready for sustainability reporting. And I suspect in 2026, there will be a big push on IFRS 18. However, if you're a big and complex business, you might have to start earlier, so not wait for our webinars. Our video can help, as you know, our leaders and our broad team. These are all the people that were there in the Gold Coast with us, our lovely team. You can join our monthly corporate reporting insights newsletters, and we'll do a whole series unpacking IFRS 18. That will start next year. And we also have e-learning. So finally, I would like to say, Kevin, thank you very much for presenting with me the whole year. As always, we've been doing this now for 7-8 years together. It's always a lot of fun. For all our attendees, thank you very much for sticking with us. We hope you join us again next year. Kevin and I love these webinars. We love interaction, and please reach out if we can help. I hope you all get time to relax over the festive season, and you get some time away from work and spend some quality time with family and friends. And if you celebrate Christmas like I do, Merry Christmas, Happy New Year, and we look forward to speak to you in January.
Goodbye.